Hello investors. Today on Simpli Stocks, we have brought a very special video for you. Today we are going to study 4 ace investor stocks that have announced very strong Q4 March quarter results. We will analyze the results and con calls of portfolio businesses of Vijay Kedia, Mukul Agrawal and Ashish Kacholia. So without any delay, let's quickly get started. The very first business we will cover is Yatharth Hospital. Yatharth has posted very strong numbers for the past 2 quarters. You can see here that this business used to grow in 20 to 30% range for some time, but during the October to December months, its sales growth jumped to 46%, and this strong performance continued into Q4 as well. The company has been opening new hospitals and acquiring others as well over the past 1 to 2 years. And now we are seeing that complete execution playing in front of us. And you will be surprised to know that this business is part of the portfolios of not just one, but actually 2 ace investors. Vijay Kedia and Mukul Agrawal both hold roughly 1% each in this company. Although on a light note, I want to add that we ourselves have been tracking this company, Yatharth Hospital, for a very long time now, even before when Mukul Agrawal or Vijay Kedia picked up a stake here. They now have a total of 9 hospitals across Delhi NCR, Agra and Jhansi Orchha, with a total bed capacity of over 2,800 beds. Out of these 9, 3 hospitals in Noida, Greater Noida and Noida Extension are older and mature hospitals. The other 5 are new hospitals that are driving good growth right now. Out of these 5, they recently acquired the Agra facility, and they recently have also purchased a new under construction hospital in Gurugram, which will start operating by April next year. So this hospital is a recent addition. This will be a 250-bed facility for which they are investing 200 crore rupees, and the advantage of this is that it will be a highly modern super specialty hospital, and since it is located in the, let's say, high income area of Gurugram, the ARPOB here will be above 50,000 rupees. So overall it will help to boost the ARPOB levels and margins of the entire company. ARPOB basically means how much the hospital earns from each bed per day, or what is their daily rate or income per bed. Now see, Yatharth is the fastest growing company in the entire hospital space, and hospitals and portals are your asset heavy businesses. So growing fast in the space or in this sector is quite difficult, because from setting up a new hospital building to making it profitable takes a lot of time. However, the execution of Yatharth's management has been very solid. For instance, they have added almost 950 beds, or let us say about 1,000 new beds in just the last 1 year. So now let us move directly to the financials and operating performance of the company. Now in Q4, that is in the months of January to March, revenue or sales have grown by a massive 47% compared to the last year. The EBITDA margin has contracted slightly from 25 to 23.4%, while the EBITDA grew nicely by 37%. But this margin compression is only short term, and this happens with, I'll say, every hospital company. No need to be worried about this. And in future, as more patients come to the new facilities and the occupancy rate goes up, the margins will automatically improve from here. So that is when we will start seeing excellent growth in bottom line as well. Besides, the business is also generating good cash now. All the new hospitals have become profitable. They are generating healthy cash profits, which management is now using to add these new facilities. Plus, the operational metrics have also been very strong. You can see that the bed capacity addition is very robust. As I mentioned earlier, the number of beds increased by about 60% from 1,605 to more than 2,500. Another positive factor here is that this number of 2,500 plus beds represents their total capacity and not the operating capacity. That is the difference, and which they can now scale up at any time. Now this might be a bit confusing for you. I'll try to simplify. So Yatharth's current capacity, like the total beds they have right now, that number is more than 2,500 beds. But although it is not written here, but the operational bed capacity which is functioning right now, so that is only about 1645 beds right now, which can be ramped up anytime. So this means that as more patients or more business comes in, they can easily add more nurses and doctors, or they can, let us say, they can add more staff to grow their operational bed count. And they have plenty of available capacity, so plenty of room to grow even from current levels. And the best part is that even after such a heavy addition to bed capacity, their occupancy rate has improved actually from 61% to 68%. Normally, with other hospital businesses or companies, you will see that occupancy rate drops when new capacity is added, because obviously it takes time to bring new patients for new facilities or hospitals, right? And this is exactly what I really like about Yatharth, that their execution is too solid. Now, their ARPOB grew by 7% for the full year, and this year they are targeting about 10% growth in ARPOB, with a 5% benefit coming from government's revised CGHS scheme rates. So that is there. Both OPD and IPD volumes remained strong. Growth in OPD patients also helped to improve the overall occupancy rate, because many patients, let us say, who initially come to a new hospital just for a consultation, end up getting admitted there if they require any treatment and they like the service. Now, Yatharth's con call was also quite positive. Let us quickly look at what management said about this financial year, FY27, and future growth. The first and best thing actually they mentioned is that this year will be even better than last year. Like the capacity they have added in FY26 will drive a strong revenue growth this year. Their top line growth in FY26 was 36%, and they have stated that they will bring even better growth this year. And then after that, from next year or FY28, margins will also start expanding, which will lead to strong profit growth. From here on, the improvements in the occupancy rate and the addition of super specialty services and also a better payer mix will help to drive this margin improvement. They have been constantly adding specialty and expensive treatments to their services, ranging from cancer care to robotic surgeries, which obviously bring a higher ARPOB for hospitals. Additionally, Yatharth's customer base is finally shifting from government employees to insurance and cash paying patients. So this is a major trigger, because government-led patients fetch fixed lower rates. Currently, about 35% of their patients come from government schemes, and this share is expected to drop to 25% over the next 2 years. And from here, Yatharth is targeting to expand its capacity to over 5,000 beds in the next 3 years. If we include the Gurugram hospital, they have already reached, I'll say, capacity of 3,250 beds. Therefore, management is also highly confident that they can easily achieve this target ahead of their 3-year timeline. And as I mentioned, their actual operational beds stand at just 1,645. So this gives them excellent room to keep attracting patients and to keep growing. So in terms of growth, valuation and potential, I'll say even after recent rally, somewhat I'll say not a lot, but whatever the rally there has been, Yatharth remains a highly attractive business for both new as well as existing investors. Moving on, the second business we will cover is Zota Healthcare. I have been covering Zota, and in fact all the businesses that we are discussing today are companies that we have covered extensively on this channel multiple times and also within our Simpli Stocks community. Now, Zota runs more than 2,500 pharmacies under the name DavaIndia for generic medicines specifically. It is a portfolio business of Mukul Agrawal, who holds about 7.3% stake in it. Now, Zota's business model is a bit unique. So let us understand it quickly. Otherwise, you won't be able to catch the true potential of this business, and it will just look like a regular pharmacy chain to you. So now see, pharma companies put in crores of money and years on research and development to develop a new drug or medicine. Once a drug is ready, then the government provides the innovator pharma company with a patent, ensuring that the drug and its formula remain completely safe. For the next 10, 15 or 20 years, only that innovator company can manufacture and sell that formula to make a lot of money and recover its investment. No other pharma company can copy and produce it. However, once the patent life expires, the formula must be shared with everyone. And the intent or benefit of this is that firstly, the prices of the drugs become much cheaper for all the customers and patients. Plus, other pharma companies are also able to conduct research on that drug and are able to develop that medicine further. Now, the entire pharma sector operates this way. When a drug goes off patent, it is called a generic drug. And you would think that maybe we would have few generics, right? But in fact, 90% of the medicines that people take or consume today are mostly generics. Take paracetamol as an example. Dolo, Sumo, Calpol, all are the exact same medicine. Dolo is made by Microlabs, Sumo is an Alchem brand, and Calpol belongs to the GSK. But people don't even know that instead of expensive brands, generics can be 60 to 80% cheaper. They can get the exact same formula at a DavaIndia store for a much lower price. And it is not only, let's say, 5 or 10% of the drugs are off patent. As I told you, nearly 90% of the medicines in India are generics, and Zota sells these generics at cheap rates through its DavaIndia stores. And not just in India, actually even in the US, which has such an advanced healthcare system for namesake, 90% of the medicines consumed there also are generics essentially. So think for a moment, in a country like India, where the low income and middle class make up such a massive portion of the population, this business can do very well in the long term. Or think of it this way, that a medicine that costs 2000 rupees elsewhere can be bought here for just 300 to 400 rupees. So the value proposition is huge for people. Now a humble request, just before moving forward, if you are liking this video so far, do give me a thumbs up. Also, you can subscribe to our channel Simpli Stocks so that you don't miss out any such good businesses in the future. You will keep receiving timely updates whenever I cover any new business like this in the future. Now, let us get back to our discussion. Now that we have understood the business model, let us look at their recent Q4 performance. So during FY26, or let us say in the last 12 months, the company has added almost 1000 stores, taking the total network to more than 2500 stores across India. This includes your 1650 approx stores company owned, company operated, or COCO stores, and about 925 franchisee or FOFO stores. And you will be surprised to know that even out of these 2500 plus stores that they have opened, actually about 1500 stores were opened in just last 18 months. So obviously, due to such rapid expansion, Zota is currently in losses. And that is why when you come across businesses like Zota or Ather, my advice is that you should not reject them simply by looking at the losses. You need to look at the scope, growth, and direction in which the business is growing. In the future, their target is to reach over 5,000 stores by FY29, and this alone translates into massive 25% CAGR growth in just store count. Also, management has been prioritizing COCO stores over franchisee stores for some time now. Now, moving forward, if we look at SSG, or same store sales growth, or basically how much sales have grown for older stores compared to the last year, or let us say for those stores specifically that are older than 1 year. So those stores delivered very strong same store sales growth of over 40%. Similarly, stores older than 2 years have recorded an SSG of about 35 to 40%. So this is also a very strong performance, which tells us that from here on, both sales growth from older stores and also the new store additions, so those put together will make sure that Zota keeps growing at a healthy pace of growth. Now, coming to their financial performance, the company's sales in Q4 in total on a consolidated basis grew by 68% compared to the last year. Within this, the main DavaIndia business saw a massive growth of about 109%. This means the pharmacy business has essentially doubled compared to the last year. And apart from this, they are also in the medical supplies business. In that segment, the domestic business grew by about 8%, while their export business fell by roughly 4%. However, this is not a cause for concern because the main driver here is their DavaIndia business. Its contribution to total sales has now reached 77%. Now, next, let us look at their margins. Their gross margin stood at 51% in Q4 last year, which has now increased to 64% this year. The rising contribution from the DavaIndia business has driven this margin expansion. Similarly, if we look at gross profit, it has increased by 109%. The operating profit has also registered a massive growth of 253%, and the operating margin expanded from 2.5 to 5.3%. Last year, they had achieved EBITDA breakeven, and this year they have reported a very healthy EBITDA margin of 7.3%. And this EBITDA margin expansion, this itself is a very big trigger, because it means that the company is right on the verge of becoming profitable, because they are expanding so fast, opening new stores at such a fast pace that their depreciation and interest expenses are on the higher side. At the PAT level, they are still not profitable, but you need to understand the direction of the business here. Do not simply ignore it just because it is at a loss. It is in losses. As the new stores mature, profitability will obviously come on its own. Like if you look at the stores that are older than 54 months, you will see that their monthly sales stand at around 5 to 7 lakh rupees. But also see that out of their total 2500 plus stores, barely 83 stores are older than 3 or so years. So as their remaining 2000 plus stores mature and touch that 5 to 7 lakh rupees per month mark, this business will witness excellent sales growth over time, and then obviously profitability will also kick in. And their management has also mentioned that in the con call, that they mentioned that stores which are older than 1.5 years, so they are scaling up very fast and they are growing at 30 to 40% rate year on year. That I told you already. Also, the management said that they will slow down on store expansion slightly this year to focus on becoming profitable. As I mentioned earlier, they had opened about 1000 stores last year. And this year, they will reduce the speed a bit to add around 500 to 700 stores. But this is only for this year. My best guess is that they are planning a major fundraise in the near future for expansion. And for this reason, they want to show a bit of net profit right now. After that, once they have funds, they might, likely want to return back to the rapid store expansion pace. Apart from this, they are also bringing in brand ambassadors for branding and marketing. Like MS Dhoni has been their brand ambassador for over a year now. And they have recently onboarded Sunil Shetty as well. Additionally, they are bringing in 2 new types of store formats. All-day stores, which are your 24/7 style stores that will stay open around the clock, and the Yugo stores. All-day stores will offer daily use lifestyle products, FMCG and wellness products along with medicines. On the other hand, Yugo will largely be B2B focused, supplying generic medicines and daily use products to other pharmacies and small retailers. They have signed Akshay Kumar as the brand ambassador for this new category. While I'm not that bullish on the all-day 24/7 stores, I really like this Yugo concept because it will expand the company's TAM. Just like Eternal has Hyperpure within Zomato, this will unlock the B2B generics market for them. And as I mentioned earlier, their target is to double the store count over 5,000 stores in the next 3 years, meaning they will be growing their stores at a 24 to 25% CAGR. Now, since the new stores will bring a very healthy SSG growth of 35 to 40%, and even if we conservatively assume just 25% SSG, so Zota easily has the potential to keep growing at 50% plus rate for the next 3 to 4 years. And personally, I am very bullish on this business model and their scope in India, and their results have also been very, very good. So you must have noticed their stores yourself too, and they are gaining market share very fast. So I would say that they are actually creating a market of generics in India by spreading awareness. So overall, Zota is a good business and you can study it further on your own. And many people who were previously uncomfortable with Zota's losses, the management is now emphasizing on profitability also. So those investors who were not comfortable, they can also look at Zota right now. The third business we will study today is Shaily Engineering. Shaily is a portfolio business of Ashish Kacholia. He holds about 3.2% stake in it. Apart from this, you will see FIIs have also been continuously increasing their shareholding in Shaily Engineering over the last 16 months or so. And just like Yatharth and Zota, Shaily is also related to the healthcare space. Now, if you are aware, the famous GLP-1 drug, semaglutide, widely known as a weight loss drug, has gone off patent in India and Canada. This drug was originally developed for type 2 diabetes patients. It works via reducing appetite, prompting people to eat less, which helps with the weight loss also. And because of this reason, its off-prescription usage also surged significantly for weight loss in addition to the diabetes. So US has already seen a rapid adoption of GLP-1 drugs. And now that its patent has expired, generic versions have flooded the market, bringing the cost down substantially. And it is a simple rule of economics that when something becomes cheaper, its mass adoption happens or sale increases. Now look, semaglutide comes in such pre-filled injection pens which are called drug delivery devices. And Shaily manufactures these very drug delivery devices. So Shaily is your proxy player for the GLP-1 boom. Right now, the demand for these injection pens is massive, but there are not many companies in the world which are able to manufacture these products. So Shaily has a kind of moat. They had an annual manufacturing capacity of 3 crore pens, which is being used for or utilized for other products like insulin, teriparatide, and auto injectors. In that, the share of semaglutide was very low. Recently in March, a new specifically semaglutide dedicated line of 2.5 CR pens has become operational, which is currently at around 45% operational efficiency. This means that there is sufficient room to double production on this line from here. And then an additional line of 2.5 crore pins will come online around July-August. After this, the company will have a total manufacturing capacity of 8 crore pins, out of which about 5 crore pin capacity will be dedicated solely to semaglutide. So in a way, within this 5 crore semaglutide capacity, we can say that they have only reached about 1.25 crore or 25% utilization. So you can see that Shaily has a substantial capacity to scale up its sales and profits even from here. Therefore, although it has moved up a lot recently, the momentum is still intact from here. Lots of scope to grow further. Their two new models, Harmony and NeoPen injectors, have also been launched in several markets. Their pens were already launched in Canada. Now, recently, one of their customers received tentative approval in the US and another customer received approval in Europe for teriparatide. So overall, company is moving in the right direction. Shaily manufactured 2.3 crore pens last year, and their target will be to manufacture around 3.6 crore pens this year and then 5 crore pens in FY28, which makes for a very healthy 45 to 50% CAGR growth. And all of this comes under their healthcare segment. Shaily used to manufacture plastic products for consumer beauty and personal care segments until now, but over the past year and a half, they have been scaling up their healthcare business very rapidly. As you can see here, during Q4, meaning from January to March months, their healthcare division has doubled compared to the last year. It recorded a 101% growth in Q4, and this is the main trigger in Shaily. However, their older legacy consumer business, in which Shaily manufactures plastic and home furniture, that has degrown by 31% due to slowdown in Europe and US. Because of this, their total sales grew by only 9% compared to the last year. But the consumer division C is a low margin business, so that didn't impact profitability. On the other hand, their industrial segment brought good growth of 60% compared to the last year on a small base. In this segment, they have started catering to an electronics company. Another significant development in this segment is that the company has entered the semiconductor industry. Shaily has received an order from a Korean company for polymer trays used in semiconductor manufacturing. Commercial supplies for this project will begin around January to February next year. And going forward, this can also turn into a new growth driver for the company. So a segment shift is happening here. First came the healthcare division, and now they are scaling up the electronics and semiconductor segments. So the company is essentially moving from low margin commodity businesses and moving into complex high margin moated businesses. Their full year FY26 sales came in at about 990 crore rupees, in which the share of high margin healthcare division has been 40%, and this was just, mind you, 21% last year. Therefore, even though sales grew by only 9% in Q4, but as the healthcare business is a high margin business, the gross margin expanded by 8.4% compared to the last year. As a result, you will see that their EBITDA margin itself expanded by massive 8.3 percentage points year on year in Q4. And if we look at it on a full year FY26 basis, an expansion of almost 9 percentage points was visible. In the same direction, their PAT also increased by 40% compared to the last year, because margins improved with the arrival of high margin business. So all in all, from here on, as their healthcare division grows further, it scales from here, the company's growth rate will accelerate even more, because healthcare is a faster growing segment. Plus, margin expansion will also take place, leading to even better growth in net profit. They are also working on even more complex products that will keep coming over time. The valuation in Shaily is a bit premium right now, you will see, but you have to understand that they have so many growth triggers. And what's more is that more markets, or let us say more businesses, will get unlocked for this business over time. Like their semiconductor business is now coming up, and then the electronics division that will also scale up. So therefore, you can, I'll say, explore this business even right now, because it is moving in such a good direction. The margins are expanding, growth rate is improving. So all in all, it is a good business which you can explore. And another stickiness, or I'll say moat, in Shaily's business is that pharma companies which have secured approvals with their injection pens in any country, they cannot easily shift to other products very easily. The development programs in pharma are quite long, and it takes time to get approvals from the government. So if you want to change your platform, which is Shaily's injection pen in this case, then you have to apply for the whole development cycle again. So that is also why market will always give a premium PE to this business. Now, after Shaily, the fourth and final business we will cover is data center company Aeroflex Industries. Aeroflex is also a portfolio business of Ashish Kacholia, and it has also posted very good results, but it has rallied quite a lot recently, just like Shaily. And because of that, what I have done for you is that I have made a separate dedicated video on Aeroflex. In that video, I have discussed everything from results to growth plans and what you can expect at the current valuation. I'll put the link down in the description below. So make sure to watch it from there, because I still see growth in that business. Lastly, if you found this video interesting or informative, then please give me a thumbs up, and also subscribe to our channel Simpli Stocks. Through Simpli Stocks, our purpose is to simplify such unique hidden business models for retail investors and then bring them to you, so that the same research that is available to mutual funds, institutions, and ACE investors, that is also available to you or other retail investors. So if you support us by liking our videos, by subscribing to the channel, I'll be much more motivated to bring more such videos for you. With this, I'll see you in the next video. Happy investing.